Sean wakes up on Monday, stretching in pre-dawn light. His mind is already halfway at work, running through the tasks that will shape his week: payroll, vendor payments, client calls. Habitually, he checks his business account from his phone before he even makes coffee. The number should read $300,000. Instead, it's $100,000 less, traced not to theft or cyber attack, but to something stranger in the transaction details: resolution procedures. Stunned, Sean tries ensuing transfers for payroll. Every attempt fails. His screen flashes the same phrase, resolution procedures, like a cold, formal denial. He calls his bank in a panic. The robotic message repeats, balance is transformed as part of bail-in restructuring, details to follow. He fumbles for clarity online. Articles neglected in his reading queue now take focus. Bail-in, the news explains, is the new tool regulators deploy since 2008, a replacement for bailouts that roiled economies and public sentiment. The mechanism ensures that losses are absorbed internally. Shareholders first, then bondholders, and last, depositors with uninsured balances, which includes commercial accounts over the federally insured limit. Sean's stomach sinks as he realizes a fact he'd never examined. Deposits are not cash in a vault. Legally, every business deposit over a certain threshold is a loan to the bank, and in a crisis, he's merely another unsecured creditor. Cyprus's banking collapse in 2013 flashes to mind. Mornings after, local businesses discovered half their funds replaced by illiquid bank shares. It wasn't isolated, Sean learns. The bail-in framework now exists in every major jurisdiction, and triggers can occur quietly. A semi-opaque decision made fast, often over a weekend, so accounts reopen Monday with balances altered, operations stalled, and funds inaccessible. Desperation pushes Sean to Google risk signals: capital ratios, exposure to derivatives, credit default swap spreads, the contents of every bank's living will. But he quickly recognizes futility. He runs a manufacturing company, not a risk desk. The warning signs, even if visible, arrive too late to matter. By the time distress signals flash, the resolution machinery is already locked in motion. Instead, he pivots. The solution isn't to predict failure, it's to avoid being wholly vulnerable. He restructures his treasury, splitting liquid assets across multiple banks to keep within insurance limits, aware the inconvenience is better than disaster. For daily operations, his firm keeps only what's necessary, always insured. For upcoming liabilities, he parks funds in short-term government securities rather than exposed deposits. Reserve capital fragments further into time-stage bonds and insured certificates, each minimizing risk from a single institutional failure. Sean negotiates a revolving credit facility, even though he dreads the annual fee. Peace of mind and business continuity is worth it if catastrophe looms unexpectedly. His insurance policies now include not just property and cyber, but a codified approach to institutional redundancy and liquidity ladders. 6 weeks into the new structure, every transfer takes a few more steps, and finance meetings are brisker, not lazier. He's shed the comfortable illusion that money in the bank is untouchable, learning instead that the bail-in is a real-world, no-permission-required mechanism. Businesses must adapt before the rules are enforced, not after. Sean's story isn't unique, but the lesson is.